We talk a great deal about our end-to-end solution in property investment here at Harbour Property, and one of the pivotal components of the investment journey is affordability and balancing debt with equity in order to drive net yields. A good majority of our clients will include some form of borrowing with their property purchase. Arrangement of borrowing is possibly one of the more complex components in the investment process, and therefore good quality advice and guidance is of paramount importance. Welcome to our latest episode of the Harbour Property Group podcast. I'm Chris Thompson, and today we'll be taking a closer look at financing your investment purchase and the use of mortgages to do so. We'll cover some of the frequently asked questions and share some current market insight. I'm joined today by Sam Lee from Capricorn International, who specialises in lending for overseas investors in UK property. Hello, Sam. Maybe you'd like to start with a brief introduction?
Hello, Chris. Thanks for having me. And yeah, absolutely happy to make an introduction. So I'm Sam Lee from Capricorn Financial. We're a mortgage brokerage, and I specialise in helping non-UK residents to get financing. So I've been at Capricorn for 13 years now. Started in our London office, which is where we're headquartered. But for the past 5 years, I've been in Singapore. So I moved here in 2019 to set up our first overseas office. And now we've got offices here in Singapore, Hong Kong, Dubai, and Shanghai. So I'm out here because I'm dealing predominantly with expats and non-UK residents in the region. So our job is simple. It's to find clients the best product and the best lender for their mortgage application. And we work with all the different lenders in the UK. Plus we're working with a number of Singaporean banks, Malaysian banks, and lenders based elsewhere. So it's quite an end-to-end service. We'll help right from the start of someone's buying process all the way through until they've found a property.
Excellent. Thank you, Sam. So before we get into the nuts and bolts of the mortgages themselves, can you share your views on the current mortgage market in the UK and how this might be impacting, let's say, buy-to-let property investors?
Yes, absolutely. Well, I think everyone knows that the past couple of years have been quite volatile in the mortgage markets and just with interest rates in total. But what has been quite good to see is that for the past 6 months, there's been a lot more stability. So, of course, rates did rise up fairly drastically, but since the kind of back end of last year, we've seen that the Bank of England base rate has held steady, but we've seen swap rates come down, which means that there's been some reduction in fixed rates, and there are further forecasts for reductions later this year. I believe we'll see the base rates come down for the first time for the past few years in the second half of this year, and that will no doubt lead to further reductions in the fixed rates. So, of course, it's been quite volatile. There's been a lot of changing with products and criteria, lenders dipping in and out. But right now, I'd say the appetite for lending is relatively strong from the lenders, and banks are wanting to get money out the door.
Excellent. Thank you very much. So good things to look forward to then, I guess, but maybe towards the back end of the year and early next for those further discounts in rates, I guess.
Yeah,
Okay.
yeah, but already we've seen some reduction. But it's a good time to look into things.
Yeah, you mentioned swap rates there. Can you just give us a little bit of insight to what a swap rate is and how it impacts the high street rates?
Yeah, swap rates, that's just the rates at which the banks would borrow from one another. And you'll have a 2-year swap rate, 3-year and 5-year swap rates as well. So the 5-year fixed rates tend to be linked to the 5-year swap rates. And the kind of consumer on the retail side of things won't always see the swap rates and won't know what they are. But this is what the banks are looking at. And so when we do see dips in the swap rates, that means that the banks are able to then borrow money on a longer term or shorter term basis at a different rate. And then that adjustment will then impact on what they can offer the borrowers in terms of the rates that they're able to provide.
Gotcha. Yeah, thanks for that. Okay, so why is it beneficial to use the specialist services of advisors such as yourself and companies such as Capricorn?
Well, there's many reasons, of course, but If you are particularly based overseas and looking to take out a mortgage in the UK, then it's extremely complex. Number one, there's dozens of lenders to choose from, all with differing products, criteria, processes, and turnaround times. And quite a lot of those lenders you wouldn't even think to approach because they're not household names. They might be kind of smaller regional building societies, but perhaps they can offer some compelling products. So it's good to have a broker on hand that has instant access to all these lenders, knows what each one of them are offering in terms of their product range at any given time, and what the criteria would be. So whether or not the actual borrower is eligible for that particular lender. Plus, as a broker, we have direct access to quite senior contacts within the banks, direct access to underwriters who are ultimately the decision makers on the loan. So it means that we can have more of an influence on the banks. So we can help to sort of smoothen out the process and make it kind of far quicker and stress-free for the clients. Plus, through Capricorn, we do actually also have access to some exclusive products that you wouldn't be able to access direct or through other brokers. So there is a chance that we can also save the borrower money.
We've heard a little from you about the current market and your thoughts on maybe what to expect going forward. How is this affecting applicant habits? Are we seeing a decrease in mortgage applications? Are we seeing an increase in longer term fixed rate mortgages, for instance?
Well, look, last year we certainly saw a decrease in applications. The transaction level was down on the year before, but already this year we have seen a great uptick, which is obviously very promising for 2024. So the inquiry levels have increased and transaction application levels are also on the up as well. So I think that's partly to do with obviously fixed rates having come down a bit, and also the consumer is sort of acclimatizing to the current interest rate environment, kind of appreciating that the times of rock bottom interest rates are behind us, and being able to sort of see the light between the trees now and wanting to sort of move on with their investment or with their home purchase.
Yep.
In terms of, you mentioned, are people going for longer term fixed rates? Not so much anymore, actually, because of the higher interest rates and the forecast for rates to be coming down. A lot of people are preferring shorter term fixed rates, like a 2-year or maybe a 3-year fixed rate, or even a tracker rate, whereby you can benefit from any downward movement in the base rate over the coming months. The rates might not be cheapest going for a 2-year fixed rate or a tracker versus a 5-year fixed rate, but it means at least you're not locking in for as long a period. And hopefully you can then refinance onto something a bit cheaper within a couple of years' time.
Yeah, thank you for that. This question comes up quite a bit, especially with first-time property investors. So it'd be great to get your view on this one. For an out-and-out investment property, what considerations should be given to the type of mortgage to apply for? So the main decision to be made is, do I take an interest only or do I take a repayment mortgage? What's your view?
Yeah, of course. This is something that we discuss in depth with our clients, and it really, a lot of it does come down to a matter of personal preference. Now, there's pros and cons of each, whether it's interest only or repayment. First of all, for an interest only mortgage, just to kind of reiterate, that's a mortgage whereby you're purely servicing the interest on your mortgage each month, and you're not paying down any of the capital. So the benefits of that is, because you're only paying interest, your monthly outgoings are going to be far less compared to if you were paying the principal as well. But on the downside, you still have a loan amount outstanding, which you need to find a way to pay off at some point. But that could be just when selling the property later on. Yep. Whereas with a repayment mortgage, the clear and obvious benefit there is at the end of the term, your mortgage is going to be fully repaid. So if you're thinking that you're buying this property because you want sort of income into retirement, and you want to maximize that income, then having paid off that mortgage is going to help. Or maybe you want to live in that property later on, and also then having that mortgage paid off will be beneficial. But on the downside, with the repayment mortgage, of course, your monthly payments are going to be higher. So if you're looking at it from an investment standpoint, then that's not always going to be good, because you might be in a position where you're having to top up each month because the rent might not quite cover the interest, capital, and all the other costs. But one thing that not everyone knows is that you can actually make overpayments on your mortgage, whether it's interest only or repayment. So if you're concerned about not having paid off the loan, but you want to minimize your monthly outgoings, then the interest only mortgage can give you that flexibility whereby you can still overpay the capital on your own terms, but on a monthly basis, the monthly outgoings are minimalized. So that's why a lot of our investors do prefer interest only, but as I say, it does come down to a matter of preference.
Okay, thank you for that. So the amount of deposit required to secure lending can differ considerably by applicant and development. Can you talk us through what variables dictate these differences, and also give us a bit of a gauge to what to aim for in terms of deposit capital?
Sure. So the deposit is, of course, going to be based on how much somebody can borrow from the bank. And the maximum someone can typically borrow for a buy-to-let loan is 75%, although there are some banks that could lend up to 80%. But let's assume you can borrow 75% from the bank, then that means, of course, you need a 25% deposit. Now, not all banks are able to lend up to 75%. Some might cap it at 65 or 70%. And therefore, by having a bigger deposit, it sometimes means you can access slightly lower rates and more lenders, potentially better policy and criteria. So, of course, it's good to be able to have flexibility in your deposit. But also what might impact the maximum loan amount is your rental income for the property, because lenders do tend to have rental income stress tests, meaning that there's a minimum rental income required to cover a certain amount of borrowing, and that's based on how much interest you're paying. And quite often the lenders want a certain buffer above that. But also some lenders take a look at your personal income and the affordability of the loan. So it's not purely based on the rent. They can also look at your surplus income to help you borrow up to the higher loans of values.
Right.
So I hope that answers your question, Chris.
Yeah, I think so. Thank you very much. And of course, the deposit capital's probably the largest financial consideration, but not the only cost involved in coming to market. So what other costs should our clients be planning for?
Well, there's a few other costs. Yes, I mean, when we're just talking about the mortgage side of things, then the banks would typically have an arrangement fee, which sometimes is a flat fee of between £1,000 to £2,000. Sometimes it can be a percentage of the loan amount, maybe 1 or 2% of the loan, which you sometimes can add to the loan. We do also charge a fee our side, so there is a brokerage fee. We charge a flat fee of £1,500. That is only payable upon successful approval of the loan, though, so there's nothing upfront to pay. And there may also be a valuation fee payable to have the property surveyed, which would typically be around £500, give or take. And of course, you are going to need a solicitor in the transaction, whether you take out a mortgage or not. But some solicitors might charge a little bit more for dealing with the lender's inquiries, because the bank will have their own legal requirements which will need to be satisfied. So there may be some extra legal charges when taking out a mortgage. So those are the main mortgage-related fees. Other than that, of course, there's stamp duty, which obviously has a few different factors. So I won't go into that in too much depth now, Chris.
No problem. Thank you very much. Okay, so it's a rare occurrence that clients will find themselves unable to borrow money for their purchase, but less favourable rates and higher deposits can be a pain in certain circumstances. Can you talk us through what influences these circumstances with lenders and their underwriters?
Yeah, there's a few reasons why someone might be restricted in their choice of lender. I mean, the first one that springs to mind is somebody's country of residence and nationality. If somebody's based in a high-risk jurisdiction or a sanctioned country, for example, then there will be fewer lenders that will be willing to assist, because some banks, they'll only lend in those lower-risk countries, and many, of course, only lend to UK residents. And your nationality will come into play as well. Also, if you're a first-time buyer in the UK, that does restrict options slightly, although there still are plenty of options for first-time buyers. But what can really negatively impact your ability to get a mortgage would be if you have adverse credit. So maybe if you have some recent missed mortgage payments or or other background commitments, you've not been able to keep up with those payments. Of course, lenders do not like that, because then they're concerned that you're going to miss on their payments.
Yep.
Or if somebody is between jobs, or they don't have a job, or the loan amount they're looking for is deemed unaffordable, then that, of course, is going to impact the assessment. And then the final thing would be on the property side of things. The lender might find something about the property that they're not too keen about. Perhaps it's in a less desirable area, or the property needs some substantial work to make it mortgageable. So there are a number of factors that could potentially impact the availability of lenders. And of course, the fewer the lenders there are, then typically speaking, the more expensive it can be.
Yeah, sure. Okay, and in terms of timing, so getting the timing right can be crucial. Can you talk us through what we should be doing and when in the purchase process for both ready to go and off-plan purchases, please?
Sure. Yeah. I mean, it's never too soon to start looking into mortgages. So it's a good idea before somebody commits to a purchase to get a good understanding of what's available to them. So what the maximum loan might be, and therefore how much deposit they need to prepare, but also what the likely terms and fees and costs are, so they can help to budget there. And we could also get an approval in principle done as well before they've actually pinpointed a particular property. We can have them approved in principle with one of the banks, which will help to save time a little bit later. And it means that we can highlight a particular bank that's willing to assist them. If it were a ready-to-go property, then of course it's good to have the pre-approvals in place, have your solicitor ready to go before you're sort of committing to the purchase. And I would say best to get a formal mortgage offer in place before you exchange contracts, and then it becomes legally binding.
Yep.
With an off-plan property, when you're buying something that's sort of got 2 to 3 years left of the construction, then of course you are expected to exchange contracts much earlier. You can still be approved in principle for the mortgage beforehand. The mortgage in principle is not going to be binding, but it does give you a bit of reassurance. And mortgage approvals, the formal approval, is typically valid for 6 months. So once you're within 6 months of completion, that's the best time to start moving forwards with the mortgage application. And the best is not to delay too long, just to ensure that you've got the mortgage approval with plenty of time to spare, so that you're not left sort of last minute scrambling around for a mortgage.
Yeah, sure. And occasionally we come across debt-averse investors. So what advice would you have for anyone considering a buy-to-let cash purchase?
Well, of course, I would tell you to take out a mortgage, because I'm a mortgage broker. But if somebody is lucky enough to be able to buy a property cash, then obviously that's good for them. However, they might want to consider taking out a mortgage to help diversify and spread the risk. So borrow the bank's money, so you're not having to put 100% of the cash down yourself. And then with the rest of the money, you could look to maybe invest in another asset class to help spread out the risk, or maybe you look to buy a second property instead. Then you can benefit from 2 sets of rental income and 2 sets of capital appreciation. Or maybe you buy one property in London and one in Manchester or another city to help spread the risk further there.
Yeah.
But also there are other benefits to taking out a mortgage. If you're looking from a tax standpoint, a mortgage can help to offset your inheritance tax liability, because inheritance tax is only payable on the equity within a property. Plus, there are deductions you can make from your tax bill based on the interest you're paying on your mortgage. So if you do have the cash, then there still are reasons to take out a mortgage, I would say.
Brilliant. Thank you. And mortgage products are not only useful for primary borrowing, of course, but also to access equity within an existing purchase. This can be particularly useful for clients looking to scale their portfolio by utilising their existing holdings. So can you talk us through very briefly the process of doing so?
Yeah, so this is something we do help our clients with quite a bit, particularly where they've got a mortgage which is been paid down over the years, or they've seen an increase in their property value, and therefore they've built up quite a bit of equity in their portfolio, which is not really working for them. So just like a purchase, you can also refinance up to 75% of the property value. So that means that you can take out a new loan based on up to 75% of the property's current value, pay off any existing loan with that, and then with the balance that's released for you, which you could then use for further investment, whether it be in an additional property or whatever it may be. If you already have a particularly good deal on your mortgage and you don't want to make any changes there, you can actually take what they call a second charge mortgage, which means there's another lender that would sit behind your existing lender to enable you to take out some of that equity. But because that's seen as slightly higher risk for the second charge lender, those rates do tend to be a bit more expensive. So the best route would be if we can just replace the mortgage altogether with a new mortgage. But another option is you could speak to your existing lender and see if they will allow you to borrow more.
Yep. Excellent. Thank you very much. Final question. Many of our clients invest in property via special purpose vehicles. We covered the topic in a recent podcast. How nicely do mortgage products play with these instruments, and what should clients be aware of when doing so?
Yeah, I mean, the mortgage products play nicely. There certainly are plenty of options available if you're buying through company structure as well. Not all banks do lend to companies, though, it's worth saying, but more lenders are starting to do so because there is a rising trend for investors buying through the company structure. The rates, I'd say, are more or less comparable, but because you don't have the full choice of lenders, you can't always guarantee the best rates. Some lenders also may have a slight restriction on the loan to value when you're buying through company structure, meaning that they can lend slightly less in the company versus if you're buying it in your personal name. That's not the approach with all lenders. And some lenders may charge slightly higher fees for doing so. But there are plenty of examples where the comparison is fairly like for like. I would say, there are a couple of extra hoops to jump through in the legal process. And of course, you do also need to set up the company and figure all that side of things out as well. So best to allow a bit more time if buying through the company. And ultimately, just to understand whether or not the structure is right for you, always good just to seek professional tax advice. Yeah,
for sure. Okay, well, many thanks, Sam, for your valuable insights. It's been an absolute pleasure. For those watching who've not yet invested with Harbour Property, an introduction to Sam and his team will form part of our overall end-to-end care package. Your advice will be impartial and free of charge unless you choose to place your mortgage deal with Sam and the team at Capricorn. Remember, your property investment decisions ultimately depend on your individual circumstances and goals, but with the insights shared today, hopefully you'll be better equipped to make a more informed choice. For more information, please visit our website at www.harbourproperty.group for further resources and to book a free consultation. And please don't forget to like, subscribe, and share this episode with anyone interested in the UK property market. For now, a big thank you to you, Sam, for taking the time to share these valuable insights with us. And from me, thanks for listening, and bye for now.